something doesn't add up in the silver market right now. The price most people see on their screens says one thing, but the price paid for actual silver says something very different. On one side, the COMEX spot price hovers far lower. On the other, the United States Mint sells silver coins at a level that seems completely disconnected. This is not speculation, and it is not a rumor circulating in obscure corners of the internet. These are public prices, visible to anyone willing to look. The gap between them is the story, and understanding that gap matters far more than arguing over which number feels more comfortable. When people talk about the price of silver, they usually mean the spot price quoted on financial news channels or trading platforms. That number comes from the COMEX, a futures exchange where silver is primarily traded as contracts, not as bars changing hands. At the same time, the U.S. Mint, a government institution, sets prices for its silver products that are dramatically higher. These prices are not hidden. They are listed openly on official websites and published schedules. The disconnect is not theoretical. It exists in plain sight, and it raises a simple question. How can the same metal carry two very different prices at the same time? To understand this, it helps to slow the conversation down and separate concepts that are often blended together. COMEX prices represent what traders are willing to pay for a promise of silver at a future date, under specific contract terms. Most of these contracts are never settled with physical delivery. They are offset, rolled, or closed out financially. In practice, COMEX functions as a pricing mechanism for paper silver. It reflects liquidity, leverage, and trading sentiment more than the immediate availability of metal in someone's hand. Physical silver operates under a different set of constraints. When the U.S. Mint produces a silver coin, it must source metal, fabricate blanks, strike coins, manage distribution, and meet real-world demand from buyers who expect delivery. That process cannot be fulfilled with a spreadsheet entry or a closed futures position. It requires inventory, logistics, and time. When demand rises or supply tightens, the cost of fulfilling that process increases, regardless of what the paper price suggests. A simple analogy makes this easier to grasp. Imagine a popular concert. Online, you might see tickets listed at a face value price. That number looks official and reassuring. But when the event is nearly sold out and demand surges, the actual price people pay to get into the venue often comes from resale markets at a much higher level. The face value still exists on paper, but access to the real seat costs more. The seat did not change. The conditions around availability did. Silver works in a similar way. The spot price tells you what silver is theoretically worth in a highly liquid financial market. The physical price tells you what it costs to acquire real metal under current conditions. When those two prices drift far apart, it signals stress somewhere in the system. It does not automatically mean collapse, fraud, or manipulation. It means the mechanisms that link paper claims to physical supply are under pressure. This pressure becomes clearer when looking at inventory dynamics. Physical silver inventories, particularly those registered for potential delivery, do not exist in unlimited quantities. They fluctuate based on withdrawals, restocking, and industrial usage. At the same time, demand for physical silver can rise for many reasons, including industrial needs, investment interest, and hedging behavior. When more people want metal than there is readily available, premiums rise. That premium is not a moral judgment or a political statement. It is the market expressing scarcity. The U.S. Mint's pricing reflects this reality. It does not price coins based solely on the COMEX spot number. It incorporates fabrication costs, distribution expenses, and market demand. When those factors intensify, the final price moves higher. This does not invalidate the spot price, but it does limit what the spot price can tell you. Spot is a reference point, not a guarantee. What matters most here is clarity. The silver market is not broken simply because two prices exist. It is segmented. Paper markets and physical markets serve different purposes. Problems arise only when participants assume they are interchangeable. They are not. Paper silver provides liquidity and price discovery. Physical silver provides certainty of ownership. The tension between them becomes visible when demand for certainty increases. This is not a call to action and not a prediction of imminent disaster. It is an observation about structure. Markets function on trust, and trust depends on understanding what is being traded. A futures contract is not the same thing as a coin in hand, just as a digital ticket is not the same as sitting in a seat. When that distinction is ignored, confusion follows. The silver price people see is real within its own context. The silver price people pay is real within another. The growing distance between those two realities is the signal worth paying attention to, not because it promises chaos, but because it reveals how the system actually works when theory meets demand. The distinction between paper silver and physical silver becomes clearer when examining how each market responds to stress. Paper markets are designed for efficiency. They thrive on speed, volume, and leverage. Contracts can be created and closed in milliseconds, allowing prices to adjust rapidly to news, sentiment, and macroeconomic signals. This flexibility is not a flaw. It is the purpose of a futures exchange. It allows producers, consumers, and traders to hedge risk and discover prices without moving large quantities of metal every day. Physical markets operate under physical laws. Metal must be mined, refined, transported, stored, and delivered. None of these steps can be accelerated by sentiment alone. When demand increases suddenly, supply cannot instantly respond. This mismatch is where premiums are born. A premium is not an accusation. It is the cost of immediacy and certainty. It reflects what buyers are willing to pay to bypass waiting, uncertainty, or allocation risk. This is why focusing on a single number can be misleading. The COMEX spot price answers the question, what is silver worth in a financial contract right now? The physical price answers a different question. What does it cost to obtain silver right now? These questions overlap, but they are not identical. During calm periods, the difference between them is small and easy to ignore. During periods of strain, that difference widens and demands attention. Inventory levels provide an important lens into this process. Warehouses associated with futures exchanges hold metal that is categorized in different ways, often labeled as eligible or registered. These distinctions matter because not all stored silver is immediately available for delivery against contracts. Changes in these inventories reflect real-world movements of metal. When withdrawals increase and restocking slows, available supply tightens. This does not mean the system is failing. It means it is being tested. At the same time, industrial demand for silver remains significant. Silver is not just a monetary metal. It is an input in electronics, energy applications, medical technologies, and manufacturing processes that cannot easily substitute other materials. This baseline demand absorbs supply regardless of investor behavior. When investment demand rises on top of industrial usage, competition for available metal intensifies. The paper market can accommodate this surge with additional contracts. The physical market cannot do so without raising prices. The U.S. Mint sits at the intersection of these realities. It does not speculate. It produces products. Its pricing decisions are operational responses to cost structures and order flows. When it raises prices, it signals that producing and delivering silver products has become more expensive or more constrained. This signal is often misinterpreted as a statement about the true price of silver. In reality, it is a statement about conditions in the physical supply chain. Another analogy helps clarify this point. Consider insurance. The advertised premium reflects average risk across a broad population. When risk increases in a specific area, local premiums rise even if national averages remain stable. The insurance company is not redefining risk, it is responding to it. Physical silver premiums function in a similar way. They respond to localized stress within the supply chain, not to abstract price models. It is also important to understand what paper markets are not. They are not warehouses, they are not vaults. They are not obligated to satisfy every contract with physical delivery because that is not how they are designed. This does not make them deceptive, it makes them specialized. Problems arise only when market participants conflate exposure with ownership. Exposure tracks price. Ownership secures metal. Trust is the invisible infrastructure that connects these systems. As long as participants trust that contracts can be settled and obligations honored, paper markets function smoothly. When participants seek physical delivery at higher rates, trust shifts toward tangible assets. This shift does not announce itself with headlines. It appears quietly through premiums, wait times, and allocation policies. None of this implies that paper prices are meaningless. They remain critical benchmarks. They influence contracts, valuations, and economic decisions across industries. But benchmarks are references, not destinations. They describe averages, not exceptions. When conditions move away from the average, other signals become more informative. The widening gap between paper and physical silver prices should be read as information, not as alarm. It tells us where demand is expressing urgency and where supply is facing constraints. It highlights the limits of abstraction in a market rooted in material reality. Understanding these limits allows observers to interpret price movements without projecting fear or certainty where neither is warranted. The silver market has not suddenly changed its nature. It is revealing it. Futures markets reflect expectations. Physical markets reflect availability. When those reflections diverge, the divergence itself becomes the message. What ultimately matters is how these two markets coexist and what their relationship tells us about risk, confidence, and priorities. Paper silver and physical silver are not enemies. They are tools designed for different purposes. Confusion begins when one is expected to behave like the other. Futures contracts excel at providing liquidity and price signals. Physical metal excels at providing certainty. Neither replaces the function of the other, but each reveals something different about market conditions. The current disconnect forces a reassessment of assumptions many people carry without realizing it. For years, it was easy to believe that the spot price was the price, full stop. Physical premiums were small, delivery was quick, and supply felt abundant. Under those conditions, the distinction between owning silver and having exposure to silver seemed almost academic. As conditions tighten, that distinction becomes practical. It answers questions about timing, access, and reliability. This does not mean the paper market is about to fail. Markets do not collapse simply because stress appears. They adapt, they adjust margins, delivery terms, and incentives. Stress is part of price discovery. It is how markets communicate limits. When physical premiums rise, they communicate that immediacy has value. When inventories decline, they communicate that replenishment is not instantaneous. These messages are subtle, but they are consistent. It is also important to resist the temptation to reduce everything to a single explanation. The silver market is influenced by interest rates, currency strength, industrial cycles, and investor behavior. No single factor explains every movement. The presence of a price gap does not override these dynamics. It adds context to them. It shows where financial abstraction meets physical constraint. For observers and viewers, the key takeaway is not to choose sides, but to understand layers. The price quoted on a screen represents one layer of the market. The price paid for a coin represents another. Both are real. Both are rational within their domains. Problems arise only when one is used to dismiss the other. A futures price does not invalidate a premium, and a premium does not negate a futures price. They answer different questions. This perspective also helps explain why dramatic language often misses the point. Markets rarely signal change with a single event. They signal it through gradual shifts in behavior. Longer delivery times, higher fabrication costs, tighter allocation. These are not headlines. They are operational details. Yet over time, they shape outcomes more powerfully than any announcement. The role of trust returns here. Trust does not vanish overnight. It reallocates. Participants decide which form of exposure aligns with their needs. Some prioritize liquidity, others prioritize possession. As long as expectations align with mechanisms, the system holds. Stress emerges when expectations are mismatched, not when prices differ. None of this constitutes advice. Understanding structure is not the same as predicting direction. Prices can move higher, lower, or sideways regardless of premiums. Futures markets can remain dominant even when physical demand is strong. Physical premiums can compress as quickly as they expand. The purpose of this discussion is comprehension, not forecasting. The silver market is often portrayed as opaque, but its signals are visible to anyone willing to distinguish between instruments and outcomes. The U.S. Mint's pricing reflects production reality. COMEX pricing reflects trading reality. Neither tells the whole story alone. Together, they outline the boundaries within which the market operates. The question, then, is not which price is correct in an absolute sense. It is which price answers the question being asked. If the question is about exposure, the spot price is relevant. If the question is about access, the physical price speaks louder. Confusing those questions leads to confusion about the market itself. The silver price you see is not false. The silver price you pay is not exaggerated. They are signals from different parts of the same system. The space between them is not a flaw, it is information. The question isn't where silver is priced today, but which price actually matters when it's needed.